I'm Danielle Hale, Chief Economist at Realtor.com. Without key government data during this record-breaking shutdown, the signals we do have on the economy are mixed, and housing is caught in the middle. First, the federal government shutdown is now the longest one on the record, surpassing the 2018-2019 shutdown that stretched for 35 days. While lenders have workarounds to keep many home sales on track, I expect to see a slower pace of October existing sales when we get that data in a few weeks. One other impact of the shutdown, we didn't get the labor market data we would typically see at this time. We have several alternate indicators, and the picture they painted was mixed. Job growth seemed to rebound and earnings rose, while layoffs appeared to pick up, and it's expected that the unemployment rate edged higher. This not only makes the Fed job more challenging, the lack of data also likely weighs on businesses and household decisions. Meanwhile, mortgage rates moved higher, climbing 5 basis points as markets adjusted to last week's Fed meeting. Although there was a Fed rate cut in October, Chair Powell's statement that a December rate cut was not guaranteed, and in fact far from it, reset market expectations for what's ahead. Looking at weekly trends in housing data, this week marked 2 solid years, 104 weeks of growing housing inventory, but the growth rate has moderated. We also saw a reversal in new listing activity, which declined after growing for the past few weeks, putting a question mark on what's ahead for the number of homes for sale nationwide. The Realtor.com October Hottest Markets report continues to highlight that the national housing market is made up of thousands of local housing markets, and that trends locally can be very different. In fact, the Northeast and Midwest continue to rank as relatively hot, even as demand is cooler nationwide. 2 other reports this week highlight the importance of local data in real estate. The Realtor.com investor report shows that a little more than 1 in 10 buyers in the second quarter were investors. But in several metros, investor activity is more than twice the national average. Further, while investors nationwide tend to target lower-priced homes, this isn't true everywhere. In some investor markets, the typical investor-bought home was nearly 20% more expensive than the recently sold typical home in the market. The Realtor.com International Demand Report, similarly, shows that property seekers from abroad have a tendency to concentrate in key markets, with Miami, New York, and Los Angeles capturing the largest shares of international shoppers in the third quarter. And more international shoppers come from Canada than any other country, but the share declined in the last year as exchange rate and policy volatility may have dampened demand from our neighbors to the north. You can find all the details, including full reports and our housing data for download, at Realtor.com/research. You can also follow us on X, formerly Twitter, for real-time updates and Instagram for graphics.